Hello all and welcome to today's webinar. My name's James Gerrish and thanks very much for joining us today on behalf of Market Matters for a post-reporting playbook. The webinar today is going to look at a couple of key things. We're going to kick off just with a quick take on our macro backdrop at the moment, just with a couple of key charts that we're very much keeping an eye on. Our take on key stocks. So some of these stocks we'll own, some that we don't, but that's exactly where the rubber hits the road. So stocks are what we're doing in terms of stocks we're owning, buying, selling, etc. Post-reporting is sort of where the key things are going to land here, and then portfolio positioning and Q&A. So we're just getting everyone sorted. Everyone's jumping online as we speak. So thanks again for joining us today. I'm joined by Shawn Hickman, who's the Market Matters research lead. I'm of course James Gerrish. I'm the lead portfolio manager at Market Matters. And before I get to introduce you to the broader Market Matters investment team, there's just a quick disclaimer to get through on the screen there. Just a reminder that any information today is of general information only, of general advice only, and you shouldn't take any information on board. It doesn't take into consideration any of your personal circumstances. In terms of the broader Market Matters investment team, to give you a sense of who we are, myself, I'm the lead portfolio manager. I've got a very well-credentialed investment committee behind me in Peter White and Peter Winty, backed by a portfolio manager in Harrison Watt, who focuses on the emerging companies portfolio, and our research lead, Shawn Hickman, who's joining me today, brings it all together and coordinates our research effort. Market Matters has two distinct areas for those not familiar with it. We're a digital advice platform, digital investment advice. We run a website that has a lot of information on stocks and how we're positioning our portfolios. We send out daily notes. We publish podcasts. Our website has dynamic data. It has consensus calls. It has portfolios to follow. We publish a weekly Q&A, etc. So there's a lot of things that go into the Market Matters digital advice service, and of course we offer live buy and sell alerts via SMS. So that's one of the really popular parts of the Market Matters service. And above all, in the digital advice platform, we make calls. So we offer analysis, we have opinion, and ultimately we provide an action. The other part of the Market Matters business is around portfolios for direct investment. This is a newer feature of the Market Matters offering. So it allows our subscribers and the broader investment community to invest in a really easy to use platform, and you can invest directly into the portfolios that we manage. Bit more information if you'd like it on the screen there. You can reach out via our website. You can talk to one of the Market Matters team, or you can email us on mminvest@marketmatters.com.au. There's a chat function there. But let's just crack into it. So I'll bring in Shawn if he's there. We're operating out of two offices today, so hopefully you're on the line there, Shawn.
Yes, I am. Nice to be here.
Thanks, mate. I'm going to start. So, Shawn, just to give you an understanding of where Shawn fits in, I'm more of a fundamentally driven investor. Shawn, I brought Shawn in to provide some really overarching macroeconomic calls and also look at more timing and technically focused calls on the market. I think it's really important, particularly in the environment we're operating in. So, Shawn, you wanted to start off looking at a couple of charts just to give a flavour for the macroeconomic environment. The 3-year bond yield was one of those. Take us through what you're seeing and why this is important from a macroeconomic perspective.
Well, we've gone through, James, a really big cycle change at the moment where we can see interest rates have started going up over the last 12 to 18 months, bond yields. And today we're probably going to get another rate rise in Australia, another 0.5% is what everyone expects, including myself. So we'll be looking at 2.35%. You know, we were looking at 0.1% only 6 to 9 months ago. In other words, interest rates have gone from 0 to over 2% in a very, very short space of time. And that's led to a huge revaluation in the growth stocks. And one of the reasons, of course, or the main reason for this, as we all know, is inflation. And we've seen inflation spurred on by another number of reasons, including loads of cash pumped in the economy post the GFC and then especially post-COVID. Now we're seeing situations because of Ukraine. We've got COVID causing huge supply chain disruption. Everything's costing more, whether you're putting petrol in the car, whether you're getting milk. So the bottom line is bond yields are going up. And we're getting to that point where we feel now is getting close to the inflection point. So the inflection point is going to be where, hang on, we've seen too much too soon in terms of revaluing the tech stocks down, and probably too much too soon in some of the commodities. So we're getting huge sector rotation. 1 week or 1 month moves across your BHPs or your CBAs or your Xeros would normally take 6 to 12 months. Is happening in a very short space of time. So what we're seeing at the moment, we think that the 3-year bonds can push up further. We think what came out of Jackson Hole week before last from Jerome Powell is saying we're not going to start cutting next year, even if we have inflation under control. And that's putting a backdrop across equities, which is really, really interesting, but means that there will be opportunities when the market decides that interest rates aren't going up as far as they feared. And a lot of people were calling up above 4% Australia. And only a few weeks ago, now they're saying sub 4%. If that's the case, some of these growth stocks are going to come back into flavor. Similarly, if they decide that we're not going to have a recession, some of the resource stocks that have been under pressure, again, are going to be appealing. So there's so much happening. It's really exciting, James.
So bond yields are really important. We often write about bond yields in our reports. And the other thing you just made mention is commodities. And one of the go-to commodity charts is copper. So, copper is often described as the bellwether of economic activity. Why is this an important chart to look at, Shawn?
Well, I think it's arguably a critical chart. Dr. Copper, it's often called, tells you where the economic activity is happening globally. Look at the price of copper. It's fallen by about 40% through this year as everyone started to get very, very concerned about central banks pushing up interest rates too far, causing a recession. Basically, central banks saying, we don't care if there's a bit of a recession. We don't care if there's economic slowdown, as long as we control inflation. That's what they're saying. And we've also got thrown into the mix China. China is causing all sorts of problems in itself. There's 60 million people in lockdown or over today, which is pretty hard to imagine where we don't have to wear a mask on a train soon in Australia. But that's led to copper being hammered. And we feel that copper is very close to having a washout, risk reward wise. There's a very good chance, I feel, of a washout in copper, simply because the market is overweight. I won't say complacently long anymore, James, because they've been hurt a bit by this pullback, but they've been sitting long resource stocks and commodities in general for quite a long time, and they're seeing the market come back. And we feel that if we get a washout, give a great buying opportunity in this space. It's all about risk reward buying opportunities.
Yeah, absolutely. We write a lot about timing of different things in the market. I think it's key to overlay that with the fact that we are investing towards longer term trends, but trying to optimize the shorter term investment in those trends. So we think copper is going higher over time on the back of the demand profile for electric vehicles and the changing dynamic around energy and how we're transitioning there. So I think the backdrop of copper looks really supportive, and that's why we're seeing BHP's made a tilt for Oz Minerals. They have a similar view in mind there, but the short-term durations come down to positioning. And I think Shawn made a really good point around the market was very much positioned long on the resources trade a month or so ago, and when the market's positioned in a certain way, pain often happens against that direction. And that's what one of the key things we've seen, and there was no more obvious aspect of that, but other than tech last year. I mean, you look at some of the big moves in technology companies that were the go-to stocks in 2021 and the early parts of 2022, they can be down 60, 70, 80% because that was such a crowded trade.
Exactly. And we're seeing that now.
I'm just gonna jump on to the Market Matters dashboard, which is where subscribers would go and look at our views and see the daily notes and look at the portfolios, etc. Of course, they get a monthly, a daily email in the morning and night, so can view it all there. And we're going to focus now on stocks. So I really wanted to have this webinar focused on stocks, what we're doing from a stock point of view, what our views are around key stocks, some that we own, some that we don't. And I wanted to kick off with BHP, which is a stock that we do have in two of our portfolios. Obviously, it's the biggest stock on the Australian market, and they reported recently a huge, a huge profit outcome, a huge dividend. Their dividend was $2.55 in Aussie dollar terms. That, if you combine franking, that's a $3.64 $3.64 dividend. It's worth that for investors. I think probably the yield is peaked out in BHP, so we're peak yield. But what do you make of it, Shawn, from a shorter term timing perspective?
Well, again, it comes back to what we just said a little while ago. We want to own BHP. It's a fantastic company. It's printing money. We like the direction it's moving. It's had a tilt at Oz Minerals, which I think will be successful. I wouldn't be surprised if they've got to pay a bit more, James, and that's why we're holding Oz Minerals in the flagship growth portfolio, albeit a trim size position. They're looking to migrate away from fossil fuels, as we know, in quite a major way. So we want to own BHP. So the question is, where do you want to own it? In 2021, it fell 35% at one stage. There's no reason why it couldn't do the same this year. So I think if it puts its head under $35, you've got to start accumulating it. Likewise, it is a cyclical company. Puts its head back above 45%, probably got to start taking a little bit off the table. But that's something you might only do once or twice a year. Somewhere where it is today, it's a high yielding quality company where you're just happy to stay long.
I caution investors buying resources stocks for yield. So, we're always suggesting that, resources stocks are cyclical, their earnings ebb and flow. And you can see that in terms of, what we're seeing on the Market Matters website in terms of consensus earnings. So revenue in FY23 is going to be lower than it was in FY22. Obviously, they've sold their petroleum business, or they've spun their petroleum business out into Woodside, so that's a reason for that. But commodities are cyclical, so I think that's one of the reasons why we take a more active stance around our positioning Market Matters. So we've got a core position in BHP. There's no doubt about that. We like the company, we like its direction, but we think you've got to be more active in the space. In terms of forecasts that we keep an eye on, BHP has got, I'll just duck back up here. It's a really loved stock. So it's got 7 buys, 2 strong buys, and 11 holds, and not a single sell in the market there. So its consensus call is a buy at this point of time, with a 42.92 consensus price target. As you can see, the next stock, we're staying big at the start, and we're going to get down into some more interesting names as we progress through the webinar. We'll go to CBA. So CBA is trading around $96 a share. We own this again in our growth portfolio as well as our income portfolio. A couple of things just in terms of the report that they came out with. Now, we met management after they reported their results recently. Their results were absolutely fine. The management were talking about how much insight they have to their customers. And this is one of the keys for CBA moving forward. And it's one of the reasons why it trades on such a big premium to the other banks. CBA's got a better technology stack than the other banks. It's more efficient in the way they operate their business. And that's why it trades on a big premium to the others. Just in terms of broker calls, you'll note that there's not a single buy on CBA. There's no buys, there's no strong buys. There's 6 holds, 9 sells, and 1 strong sell. That all comes down to relative valuation. So CBA trades on a 41% PE premium to the sector, so it's expensive. Obviously quality has been, people have, the flight to quality has played out. But Shawn, what's your take from a timing point of view around CBA, and how would you suggest that viewers could potentially play CBA here?
I think it's a very similar story to BHP. It's a quality company that keeps on delivering. You're dead right. Everyone's saying it's expensive, but it's been expensive for a long time for a reason, because it keeps performing. Every time we've looked at a few times over the last year or two, maybe switching out of our core CBA position, and every time we haven't, and I'm really glad we haven't. It's paid
I
off to do
agree.
it.
Yeah, absolutely. Every time we've in the last 10 years, every time I've sold CBA to buy a lower quality bank, I've been disappointed with doing that. It hasn't worked.
Exactly. Sometimes it's best not to try and overthink things. Until CBA gives you a reason not to be overweight CBA, stay there.
So CBA is a core position in the flagship growth portfolio and the active income portfolio, just to clarify that.
Exactly. And so in terms of timing and price wise, it's simple. The stock's been trading around $100 for the last 15 months. If it goes up to 110, you might want to trim a bit off. If it goes down to 95, it goes down towards 90. So basically 10% either side, add to the position. Keep it simple. That's what I'll be doing.
We're at the midpoint of the trading range in CBA, so as you can clearly see on the chart on the screen there. So CBA, we've got a hold now. We're a buy at lower levels, but we're a seller if it rallies up into the 110 region. One of the interesting stocks, and I thought this was actually the best result of companies that we own this reporting season, was Altium. So Altium, they're a designer of printed circuit boards. So they have a software platform that allows designers out there to design printed circuit boards. Now, they underpin all sorts of electronic gadgets and developments going forward. And this was a result that pretty much blew the market blew the market away in terms of versus expectations, plus also guidance for the future. So ALU does feature in our flagship growth portfolio. We've held it for a while. We held it through the Autodesk bid for ALU. Unfortunately, we didn't sell it into that bid. That bid got knocked back, and the stock price came well back down into the 24 range, but it's now back up into the 35 range after a really strong result. Two things caught my eye here. So obviously FY20 was very strong, but the FY23 guidance was good, but they also came out and they rejigged their FY26 revenue for target. So they've got this $500 million revenue target for FY26. What they did at this result, they said that is going to be driven by organic growth, not by acquisition. So the market had previously thought that was going to be 10 to 20% driven by acquisition. So it was really a quasi upgrade in terms of that as well. So I like this. I think the business has got really strong momentum, and we've also heard similar trends playing out from other overseas players in the space. So what's your take from a technical standpoint here, Shawn?
I think it looks great, James. Simple as that. Absolutely great. If you get a chance to buy it under $35, I'm getting very micro there, I would buy it. But I think right here, right now, the stock looks fantastic. And if we weren't long, I think we'd be having strong conversations about getting on board even after its strong move.
What do you think it's worth on the upside? So obviously, Autodesk came out, and I think it got to 47. There was, I think I'm going off of memory here actually now, where I think it got to 45 in terms of the bid that got put on the table for Altium from Autodesk. That's at the top of its trading range. Altium thought they were worth more. It seems to me that they have got really strong confidence in their business over the coming few years. And when they actually knocked that bid back, they had a huge amount of confidence when they did that. Going back and listening to the conference calls, etc., and that played out.
No, exactly. And I think we have heard a few people think their businesses are worth more during takeover bids over the last year or two. It's been
we all do, don't we?
We do. That's in case anyone wants to come and buy Market Matters. But on a similar, more realistic note, Altium looks great. And I think that if we see bond yields pull back a bit or just have a rest on the upside, and the whole market concern about rising interest rates calms down, James, as I alluded to at the very beginning of today's conversation, I see no reason why Altium, the way they're heading, couldn't end up with a 5 handle.
Yeah, it's been, if you the context of what Shawn's speaking about. So you saw the 3-year Aussie bond yield, last month. Obviously, it was a very strong month for appreciation of yield. So bonds got sold, yields went up. In the US, the US 3-year yield, I think, was up about 52 basis points in the month of August. So for Altium and other tech companies to rally in that sort of environment, it implies a huge level of strength in their business. WiseTech was another one that did a similar thing last month because their results were simply stunning. And I think Altium's results were simply stunning as well. In terms of what brokers think of it, there's not a lot of love for Altium in terms of brokers. We're trading around about the median broker target price at this stage. There will be mainly a hold recommendation in terms of the broker community and a target price slightly lower than where it's trading at now. So that doesn't concern us. So it doesn't concern us when the market is split on a stock. It doesn't concern us if they're all, if analysts think a particular way. You've got to think outside the box to make money over and above the index return in this market. So I wouldn't get too caught up in terms of what brokers are calling on Altium. Macquarie is a stock that is pretty much universally loved. I'd safe to say, Shawn, we own it in our flagship growth portfolio. There's not a lot I can add here. I think it's a great business. I think the diversity in its earnings streams, from capital markets to financial markets to lending and the like, they're all split sort of 30-30-30. It's a really diverse business run by some very smart people. What's your take on Macquarie here?
Very similar to what I was talking about with Altium, although not quite as dramatic, in that I wouldn't be surprised if this market holds together, which I think it will. If we see Macquarie challenging some really high levels, so I could see Macquarie back towards 200 into Christmas. That wouldn't surprise me at all. I know that's a bit micro. We were very happy to trim down our positions slightly into the recent rally because we were very long the stock, and the market loves it, as you rightly point out. But then again, it doesn't love CBA, and CBA keeps going up. So I think you've got to be a bit cautious, as you rightly say, with what everyone else thinks. But this is a quality business. It keeps on delivering. They love to under promise and over deliver, which is something I think is a great sign in a business. And I think we can see $200 into Christmas. It wouldn't surprise me at all.
Yeah, assuming the market holds together, I think you've got to be conscious that this is a very market-linked play. So whilst, if I wind back the tape 5 years ago, Macquarie was a very transaction-orientated business. Now they're a lot more diverse, which is the comments I was just making initially. And they've got the stability of fund management. They've got a really good infrastructure business. They own a lot of physical assets around the world. So they're a little bit of a different business than they were 5 years ago, not as volatile, but they are still very much linked to asset prices. When asset prices fall, that doesn't bode well for Macquarie. So I would say that that's probably played out so far in the last 12 months. The next 12 months will probably be better as interest rates probably stabilise from here. So the backdrop for Macquarie, I think, looks okay, but just be conscious of that if you're investing in Macquarie, and in terms of the allocations that you'd have in that particular stock. As Shawn made mention of, we've trimmed it recently into the prevailing strength. Xero is a business, an accounting platform that everyone loves. I use. We've held this stock for a while, but ultimately it caught me by surprise how weak it was over the past 12 months. You can clearly see on the chart in front of you that it had, this was a stock that did particularly well in 2021, got up to sort of 156, 157 bucks a share. It's now languishing down there at 80 bucks a share, or $84 a share, having lost 44% of its value over the past 12 months. They provided they didn't report this earnings season, but they provided an update at their AGM, basically around their UK business, which they say the subscriber growth is not as strong as they hoped it would have been. They've got net cash on their balance sheet of around 51 million, and they've got undrawn facilities of about 150. But to me, it's now becoming a little bit. They've got this big growth push. They may tap the market in FY23 to underpin that growth push. But what's your take technically on this one, Shawn?
Well, I'm glad we trimmed it a bit. Same sort of thing. If we see new lows, I'm happy to put that back into the portfolio the same size we had before. Likewise, I can see the stock trading in a trading range between about $70 and 100 and maybe 115. It's going to go and has been going very, very much in line with or inversely to bond yields in an amplified way, James. So in other words, we've had significant value contraction across the growth space. And then, Xero's been experienced that on steroids, which hasn't helped by the fact that they might go to the market and raise money, etc., as you said. But I think that we will see, if we see an improvement in the tech side of things, if we see it calming down in bond yields, we will see Xero higher. But I wouldn't be looking to increase our position size unless we saw a testing new lows, or new recent lows.
One of the things that's when we think about Xero, it's a phenomenal business. They're investing a huge amount of their earnings into a land grab to be one of the two global players in the online accountancy space. So you look at the revenue that is being generated in Xero. It's not that what they're doing is working. They're just investing heavily for the future. So, a lot of people will go out there and cite high PEs and the like, but at the end of the day, this is a company that is growing their revenue very strongly. They could turn very profitable in a short amount of time if they turn the growth lower. I don't think that's what they should be doing, because their platform works so well, because they need to go out there and push into other jurisdictions. They're spending money to do it. And that just gives you a quick overview of the revenue profile that Xero has got, and that's available on the Market Matters website, as you can see on the screen there. In terms of what brokers typically like Xero, 7 buys, 3 strong buys, 1 hold and 4 sells. The 4 sells will be on valuation grounds, but consensus price target for Xero is $98.83, so it's well under that at this point in time. The next stock I want to look at is a lesser known company, although it's gaining some popularity. It's called Ordinate. AD8 is the code for that. It's trading around $8.49 a share. It's had a reasonably tough 12 months. It's down 20%, but it has outperformed some of the other technology companies out there. We own it in our emerging companies portfolio. We remain long and bullish the stock. You can see from the 52-week range that it has been as high as nearly $11 in the last little while. If you think about, so Ordinate do these audio visual systems. In the room that I'm sitting at now, we have Ordinate equipment in here. In our boardroom, we have Ordinate equipment in here. I'm not sure if the new Sydney football stadium or Allianz Stadium has it, but the stadiums are another area that they put their gear into. This is a great business. It's small, but it's a main player. It's a very dominant player in the business that they operate in. Shawn, quick technical take on Ordinate.
I like the stock and I like the business, and I'm sure Harry's very happy to have it in the emerging companies portfolio. It's going through a small pullback at the moment. We all can see that. I think if it was to go any lower towards $8, you'd be thinking about increasing any holdings. It looks good.
So it's it's very much a growth stock, and very much something that when we think about growth stocks, we want a stock that is, to state the obvious, growing strongly, but has a really competitive position in the industry that it's operating in, and then a willingness and a desire to grow that competitive position over time. So Ordinate is one of those really high quality businesses, known it for a long time, held it for a fair while. And we continue to like it in our emerging companies portfolio. It's one of the core holdings we've got in that portfolio that has been there for some time. So we like Ordinate at this current point in time as well. Goodman Group in the broader property space. So we went into this reporting season. Me personally, I was speaking about the market being very negative on property going into it. Property hasn't performed well in August, so we've probably got that wrong in the short term. Goodman Group is obviously at the pointy end of property, but it's a more growth focused developer of property rather than a real estate investment trust, which is very much a yield focused investment. Goodman Group, I like from a fundamental point of view, but what are you seeing in this from a technical standpoint, Shawn, at the moment? Because it's been a little bit muted in the last little while.
Absolutely, James. I think it's a world-class company, but it is tarred with the same brush as being linked to property and being linked to growth. They haven't been two great things, as we know, over the last 12 months. But I think any further downside, I'd be buying into Goodman. So we trimmed our position into the recent strength in Goodman's, but would be very happy to increase back up if we did actually see another sell-off.
So it's a similar sort of approach we're taking a lot of these companies. So we're trying to furnish our portfolios with really, best in breed companies, trying to optimize the way we approach them. So, upweighting into weakness, trimming into strength, and trying to actively manage our portfolios in line with those views. So where would you, like, as a, hanging your hat on a price level, where would you be an accumulator of this stock, Shawn?
Okay, well, there's two parts to that thing, and I would like to bring everyone back to our mantra at the very start of this year, which was, for the first time in many, many years, Market Matters said, buy weakness, sell strength, but with a bias towards a sell strength. And that's proved to be the case this year. So I think, again, coming back to what I'm saying, buying weakness, if I had no position, James, I'd be buying on the back foot now. But we do have a position, so I'd be quite fussy where we increase it, and I'd be wanting to look under 18 back towards 17. So there's two different questions there. If I had no position in Goodman's, I'd be buying on the back foot today. If in terms of the position we're holding in the flagship portfolio, I'd want the stock under $18 before we jumped in.
Yep. So to give you an idea of the portfolio, we'll just skip on here, just have a quick look around where we own Goodman from. So we own it from $23.45. We're actually down 18% on this position. We have trimmed some of it recently. We had a larger position in Goodman, but this is one of the real values of the Market Matters service. We put our portfolios on there for all to see. We track our performance on a monthly basis. We put it up there in plain light, and we also present our views around the positions as we have them in the portfolio at that particular time. And this is 20-minute delayed data, so it updates on a daily basis. Goodman Group. So I think, just broadening out that conversation on property, we've just done I was just writing this morning, the Market Matters Invest monthly portfolio reports, and one of the stocks that we've just recently added in the income portfolio is Centuria, CNI. It's a stock that was down 45% over the course of the last 12 months. We think that's oversold. It had a reasonable report when they announced. One of the things that I've noticed in the property space over the last little while has been this downgrading of FY23 guidance on the back of higher interest rate expense. So I think there's been a lot of property companies guiding conservatively into FY23, and we've taken a little bit of a counter skew on that. So we've started to look more closely at property companies, particularly in our income portfolio for Market Matters. One of our most recent buys, Shawn, is in Ramsey Healthcare, RHC. Just to give you some background there, obviously Australia's largest private hospital operator. They came in April. There was a KKR-led consortium which made a bid for Ramsey Healthcare at $88 a share in an all-cash offer. Subsequent to that, the market got concerned that bid wasn't going to take place or wasn't going to proceed. That has come out to be the case, so that they have walked from that bid. They did put a lower, essentially a bid on the table, which involves scrip and some cash, which valued Ramsey about $84 a share. We've gone and bought this around $70 a share. I think it was 71 that we added it to the growth portfolio at. Shawn, what's your take here? I really like this play. I think it's one of these things we'll make money on in the next 6 months.
Exactly, and I think that's the time frame. Don't rush. Don't expect anything tomorrow. It's a quality company. Somebody out there, at least one company out there, wants it. They want to buy it. They're prepared to pay a significant premium for it. And look, we're buying it today, very close to the pre-takeover bid. So it's a company we like anyway. We like the way they're going. We like the way they're expanding. They paid a nice dividend this week. I don't see any real great downside with this play, which is scary because I don't like saying that, but it feels great. And
always
as you say,
scary.
I think we will make good money from this position. I think they'll come back and do a deal, is my gut feel.
The trends in Ramsey Healthcare, or the investment thesis in Ramsey is that they've got valuable property assets that you can't replicate. So they've got a lot of freehold property in Australia. They've obviously got an international business as well, but it's those property assets that could be spun out and monetized monetized by someone else. So KKR was trying to put a consortium together to buy the business collectively, spin the property assets out, do a long-term lease back sort of agreement with those assets, and generate returns out of that. We think the underlying assets are worth a lot more than probably the share price is reflecting at the moment. Their earnings have been subdued because of COVID. So COVID earnings, this has been impacted by COVID. There's no doubt about that. So their earnings have been, not as, this is a growth company, but their earnings haven't been growing a huge amount because of COVID. Coming out of this, they will start to grow their earnings. There'll be a lot of pent-up demand for elective surgeries that will benefit Ramsey Healthcare. But in the interim, I think this is going to get taken out. So, for us, I think this is a really good risk-reward play for that portfolio that's going to be a little bit counter to anything the market does. So we like it here, Shawn, as we've just both agreed with. Oz Minerals, which is obviously, we spoke about copper earlier. Copper is been in focus in the last little while. You talked about your negative view on copper, Shawn, but we own Oz Minerals and we're drawing some upside from the BHP bid. Perhaps give an understanding of what we did with our position when the bid came through and how we view the position from here.
Okay, just very quickly, I'm not negative copper. I'm looking to buy or hoping to buy weakness. There is a slight difference there, just in case any of our subscribers get confused. With Oz Minerals, we were long into the bid by BHP, which was great. It's always nice to turn on the screen in the morning and see that come through. We simply trimmed the position from 5%, I think, back to 3%. Correct me if I'm wrong, James.
We did.
For the same reasons as what we saw with the Ramsey Healthcare, just in case BHP, I won't say walked away, but they couldn't get the deal done. I think this deal will go ahead at around $30. BHP want to increase the metals. They want to increase EV metals. Copper's a perfect fit for BHP. And we all know they've got the money to do it. So I think this will go ahead, and I think it will go ahead near $30. So we just took a little bit off the table, but we're still running 3% for that very reason.
When we have we did have a 5% position, that then the 5% position obviously went up by 40% following that bid amount. So you end up getting a higher concentration of that stock in the portfolio. So we've trimmed it back to a 3% weighting, and we'll let the rest play out. $30 would equate to 1.4 times NPV. So when if you go back historically and look at some of the multiples that mining deals of high quality assets like Oz Minerals have garnered, then it's something like 1.3, 1.5, some even higher multiples of their net present value of their asset base. So we think that's probably likely. We had Andrew Cole in, who's the CEO of Oz Minerals last week into the office, just talking about, and he's one of the most impressive mining CEOs, I think, in Australia, and if not the world, articulating the value in their underlying asset base. And I know Oz Minerals came out with a weaker than expected earnings report that we wrote about at the time, but the value of their underlying assets and how they'd complement BHP's copper assets and how they'd help to improve BHP's copper assets, I think is pretty compelling. So while a lot can go wrong with corporate transactions, and that's why we trimmed our holding, we're very comfortable seeing the rest of our holding play out from here. So let's fingers crossed that they'll come back and make a tilt at near that $30 a share mark for Oz Minerals, and I think that's probably the level that they would need to pay to get the deal done, if not slightly more, as the feeling that I got following the discussion with Oz Minerals. One of the more recent positions we've added in the portfolio is Iluka. Iluka is a mineral sands play. Mineral sands is used in paint production and tiles and the like, but they're also developing a rare earths business that rare earths is what Lynas does, and this could potentially be the size of Lynas in their rare earths business. So it's a company that reported well, and we actually bought it post reporting at slightly higher levels. So we're slightly down on their position at this stage. But what do you make of it at the moment, Shawn?
I think it's a great company. I like the direction they're going in on the fundamental level. Technically, I just think it's an accumulate into weakness. We are, for example, in the flagship growth portfolio, we are cashed up. We do have high cash levels. This is one stock we could increase if it went, another 5% lower, if we decide not to diversify elsewhere.
All right, so it's one of these, when you go out there and you're adding positions into your portfolio, they've got to have what I like to, I like to see, obviously, the financials of the business stack up, but then a bigger pie at the end. So a driver for growth, whether they're expanding their asset base, whether they're making acquisitions, whether they're going out there and turning changing their, really up-speccing what their business could do over the next 3 to 5 years. And I think Iluka has done that. I think the trends in the underlying commodities that they are mining have been incredibly strong. And I think the supply backdrop is incredibly tight. So similar to what we're seeing in the energy markets at the moment, there's not a lot of new supply in these areas coming on stream. One stock that is bringing mineral sands on stream is Strandline, STA, which we own in our emerging companies portfolio, and that's done particularly well, but it's not nearly the size of what Iluka is. And Iluka really controls the market in that space, but it's this rare earths component of their business they're developing that is of particular interest to us. Shawn, I heard you this morning on Ausbiz talking about Newcrest. This has been, just so we're very forthright in the way we show what we've done, right or wrong. Newcrest has been one of the poor positions in our growth portfolio for a while now. What's our take in NCM at the moment? It's trading around $17.09.
Well, as I said this morning on Ausbiz, it's been shocking. It feels shocking. It's it's one of those stocks that doesn't make me feel particularly good when I look at it on a week-to-week basis in the portfolio. But if we had no position here right now, I'd be looking to tickle some on into this current weakness. I think it's getting
tickle some on. That's a new term, Shawn.
Okay. Well, I'd buy slowly on the back foot.
I get what you mean. I like it.
Yeah, we buy slowly on the back foot. You wouldn't throw the kitchen sink at it, is definitely a phrase I use today. But we are seeing a few contrarian indicators come through. I think the US dollar's blowing off. I think the bond yields might be near the top of their cycle. I mean, they've obviously had the Jackson Hole news, but all those things are in the market, and they're all a headwind for gold. So gold's been hit with the kitchen sink, but what comes next? And I don't think there's a lot more that's going to hurt gold in the near future. So I can quite easily see, for example, Newcrest Mining trading between $16.50 and $21 over the course of the next 6 months. And that means risk reward, it's starting to look like a good buy.
So we're not going to add to our position because we've already got a position there. We would look to trim it into strength, but we're certainly not sellers at this current point in time, simply because the headwinds of gold seem to be easing. So that's a high US dollar. We think that's near a high. We think bond yields are potentially near a high. And we think some of the headwinds around inflationary pressures, so cost pressures in terms of their operating metrics, have also been a headwind for gold companies. Newcrest, actually, when they reported this time round, was better than a lot of the other gold companies in terms of their operational performance. Just no one likes them. It's as simple as that.
No, when you're in the doghouse, you're in the doghouse, aren't you?
Yeah, absolutely. I've been there before. Mm-hmm. Now, in terms of a stock that's probably on the other side of the spectrum, that has done particularly well for us in the last since we acquired it in the emerging companies portfolio. I think we're up something like 30 or 40% on this position, is retailer Lovisa. My oldest daughter loves this store. I can see how they're making money. They sell earrings for a couple of bucks that will cost them a couple of cents to make. Their store fit outs are very let's say economical. Some might say cheap, but I can understand how they're making money. It's hard to be negative on a trend like that, Shawn.
Oh, totally. And I walked past their store in Chatswood in Sydney on the weekend, and I looked in and I thought, wow, it was packed, James. And there were plenty of other stores, within 50 meters that were literally empty. So no, I think it looks good, and I think from a stock point of view, any dip under $22, if I didn't have a position, I'd be tempted to put some on.
Yeah, Harry originally wrote a couple of weeks ago that we could look to sell the position into new highs. It has gone and made new all-time highs. So obviously that is an uncommon theme that we're seeing in the retailers. If I read one more negative piece about the retailers going into this reporting season, I would have screamed. But most of the time, the retailers have done better than the market had feared, and Lovisa is one of those ones that have done stunningly better than where the market was positioned for leading into this reporting season. And they're up from $13, and they're now up above $22, $23 at this point in time. They've had a simply phenomenal run. They're expensive, but the trend is clearly behind them, and the business is kicking goals, particularly with their overseas expansion. So this is one retailer that is growing very strongly and doing it successfully. Aussie Broadband, I've got to say, is one of the disappointing results that was out during a reporting season. Effectively, this is a telco. They've had a number of downgrades throughout the past year or two. We really like this business, and we hold it in our emerging companies portfolio, but it hasn't been particularly good for us. This reporting season, they came out and lowered their guidance for earnings going forward. My take out of that when we met management was that they're now guiding conservatively. FY23 could ultimately be a lot better than they had feared. But the trends, you can't argue with it. The trends are down, Shawn, and we've shown some patience here, but we've probably been wrong on this one in the short term.
Oh, definitely. Hindsight's a very clever trader. It does remind me a little bit of Newcrest mining. It's more than halved this year. So it is a tough one there. And it's a tough one to manage. I'm sure if we didn't have a position, Harry will be thinking about accumulating below 250. And I still think that's probably what I'd be inclined to do in this stock. But likewise, any test it back towards $3, I'm sure he'll be thinking about lightening it off as well.
The catalyst around this are a couple of things as we identify. So the first is repricing of the NBN relationship. So NBN is the pricing there has been probably more, it hasn't suited the likes of Aussie Broadband. So there's a catalyst there in terms of the changing of the NBN pricing. Origin Energy operates a white label of the Aussie Broadband services. So they've got some really aggressive targets out there of customers they need to get on board. They're published targets. So they can either do that organically via the use of Aussie Broadband's white label service, or they can go out there and acquire Aussie Broadband. So I think there's some takeover appeal in Aussie Broadband, and they've also going to realise the benefits of the over-the-wire acquisition that they made in FY22. So you can see on these numbers, revenue is going to go from 350 up to about 813 million. So the business is growing significantly. There's been a big change in the size of the business, but these guys manage it well. They, I'm perplexed around why the market has treated them so harshly. If you look at some of the forecasts in terms of broker consensus, you can clearly see, the medium broker forecast is $4.22, a target price is $4.28, I should say. The most bearish in the market is at $3.10, and it's trading at $2.51. So the market was probably caught a little bit long on this stock, but I've got to say, it looks to me like a compelling buy for a number of reasons down there, and it sort of fits that the type of stock that we want to have in our emerging companies portfolio. That is, it may have a few little warts on it at the moment, but the growth outlook is really strong, and there's a couple of catalysts that can sort of get that growth being realised by the market from here. There's a couple I want to finish off with. The first one is AGL Energy. This is one we held in the income portfolio in 21, and we did really well out of it. We bought it. I think we ended up selling it around $8.40. Having bought it, I think it was around the. I can go and have a look here. So one of the joys of the Market Matters website, you can go in and have a look at where we've bought things and how we've traded them. Remains neutral at best. Okay, he's looking to take a small 3%. So we have bought around $5.33. So we bought a 3% holding around $5.33, and we ultimately sold it around the $8.50 level. So I think it was $8.36. Yep, taking profit around $8.36. So it was a great trade in the income portfolio. A couple of catalysts here, obviously, similar to Ramsey, we think their assets are worth more than what the share price is implying, and Mike Cannon-Brookes shares that view. They've got some huge headwinds around ESG and the like, but from a technical standpoint, we think there's a couple of catalysts here from a fundamentals from a fundamental perspective. But what do you make of it from a technical perspective, Shawn?
I think it's a stock that it's obviously very much in the defensive corner. It's got a few interesting scenarios that could unfold, as you mentioned, and purely from a technical point of view, I like it around $7. It's rallied from $5. It rallied up towards $9. It's just come back to the midpoint of that rally, which is typical what stocks do in an uptrend.
So 8.25 was the price that Cannon-Brookes lobbed a bid in. So we're trading down at the low sevens. Clearly, there's going to be some. I think there's still interest sloshing around for AGL. I don't think he's the only one that will see value in the underlying asset base. And a lot of people say to me that it's all around, it's an environmental play and the like. Mark my words, billionaires don't become billionaires without having a commercial tilt on transactions. So we think there's value there in AGL, and we actually we wrote last week or the week before, just in our income report, that we're looking to add to it to take a position again around the $7 mark. Woodside's been a phenomenal performer, Shawn, obviously on the back of a number of things, not least the strength in the energy complex. What's your take on Woodside here?
I mean, we did have a target for Woodside to pop above 36, where we thought we'd start monitoring the position carefully, with maybe the thought to take a bit off the table. But when I cast the poll a bit further apart field and look at stocks like Chevron and ExxonMobil in the States, I think they all look like they're going to go higher. So if the global oil and gas sector is going to go higher, the likelihood is Woodside will follow too. So at the moment, I'm happy to stay long. They're paying a very big dividend soon, $1.09 fully franked. That's US dollars. So I'm happy to stay long here. Again, into new highs. Keep an eye on it. But unless there's a reason otherwise, I think the stock probably grind higher. But it is looking a bit tired. It is a cyclical stock, and we know that cyclical stocks do eventually run out of steam. But at the moment, I wouldn't. I'm happy to stay long, just watching carefully.
All right, we own Exxon in our international equities portfolio as well. We recently bought that into weakness and are doing well out of ExxonMobil. We've got a couple of questions coming through, so I'm just going to get to those very quickly. What is a washout, Shawn? Describe a washout for us. It's not you having a bath.
No, it's not me on the weekend. It's quite simply where a lot of stops go off. So you've got a situation where the whole market is long. Well, I'll give you a great example. It might be Bitcoin. Everyone got long Bitcoin. Bitcoin starts to make new lows, or it starts to take out monthly lows, quarterly lows. These people that are leveraged, they get stopped out, and you get a very quick move, panic selling, which creates a situation where the stock, or in Bitcoin's case, the cryptocurrency becomes very, very undervalued and worth buying. So that's a washout. Too many people pointing the same way, getting stopped out.
What you get is this big bar that goes down, and a big long tail on a bar, or a long tail on a candle, and that's typical of a washout there, Nick. In terms of, there was a question just on if you could only buy one CBA or MQC, I'm presuming that would be Macquarie Group, MQG. Which would you choose, Shawn? This is just a reminder that it's general advice only here, so we're not talking about what any individual should do. In those stocks, my leaning would be in terms of Macquarie, given its diversified nature, but it's a lot riskier proposition than CBA. CBA is a lot more, is a lot probably a safer stock. And the number of portfolios that have a core position in CBA, I think, is quite extraordinary.
No, I agree totally. And I think what you can come down to is if you're bullish the market, you'd probably lean towards Macquarie Bank. If you're a bit scared about what comes next for the global economy and the stock market in general, you might lean towards CBA. But they're both companies that I could easily toss a coin on that one.
In terms of at what point is CNI a screaming buy? Darren has asked around CNI. So this is Centuria, Centuria Capital. So Centuria Capital is a fund manager, and they also invest in other Centuria funds. So you'll see the chart on the screen in front of you. We've actually just added this to the income portfolio, just below $2. We think it's a screaming buy now. So anywhere below $2, Darren, we think Centuria is a screaming buy. You've got to have a medium-term outlook in terms of Centuria. So I think the property complex is going to be more probably difficult over FY23. So we met with John McBain and Jason Hulich, who run Centuria, and they were speaking as such, but they're pretty optimistic around what they can deliver. And I get the sense that their guidance for FY23 was on the conservative side. Thoughts on uranium here? So we own Paladin in our emerging companies portfolio. We like uranium. We think it's going to do particularly well over the next sort of 3 to 5 years. We think it's a medium-term play here, but this is, the uranium price has been moving up, and it's incentivizing production to come on stream. And we've seen Paladin come out there and confirm that they're going to restart their Langer Heinrich mine. So I think the question talked about EL8 or Paladin. So we're staying more in those companies that are nearer production. So Paladin is certainly the premier uranium stock, and we also own the Sprott Physical Uranium Trust in our ETF portfolio. So that holds physical pounds of uranium, and there's another way to play it. It's listed in Canada. So go and have a look at the ETF portfolio for a view on that. In terms of at what price do we like BHP? Shawn, we said $35 from memory.
Yeah, any dip down to that sort of area, you'd be accumulating back BHP without doubt.
So Stephen has asked about, do we have any view on mineral resources? So mineral resources is obviously there's 3 components of the business. There's a lithium business, there is a mining, there's an iron ore mining business, and there's a mining services business, crushing and the like. So clearly the lithium business is what the market is getting excited about here, less so the iron ore business. They've got a higher cost of production. They're about $90 a ton in terms of their production in their iron ore business, and their crushing business sort of just ticks along, and crushing and mining services, I should say, and ticks along. So mineral resources, I like the stock. It's up the top of the range. I know there's a lot of other, Airlie loves this stock. I've listened to Emma Fisher's comments about mineral resources. From a technical standpoint, what's your take here? I actually like the stock and like the story, Shawn. But
is that a warning before I make my comments, James?
It sounded like one, didn't it?
It did. No, I think it's a bit like the chart of Paladin. Actually, I think it's one of these stocks that will be trading a lot higher in 3 to 5 years' time, because of the lithium story. But it is a volatile stock, as we've seen. It's fallen 43%. It's fallen 35%, all in the last 2 years. It's a volatile stock. You are buying at the top of the range now. So if you buy some up here around $60, keep a bit of, which I don't have a problem with whatsoever, but keep some ammunition, because it could be very capable of dipping back to $55, $50. It's done it so many times before over the last few years. There's no reason why it can't do it again.
Yeah, absolutely right. It's a stock it's a company that's driven by its, MD, and the market loves Chris, and is backing him to deliver what he's saying is going to deliver. So they're going to be a big lithium producer. They're going to have a lower cost iron ore business, and they're going to help fund all that by putting money and putting production through their mining services operation. There's a bunch of questions backing up now. So in terms of thoughts on Strandline, so John, I did mention Strandline recently. So this is a W-based mineral sands, soon to be producer. So they're just about to sign off on their Coburn operation. So that is coming into production. They're about 90% complete on that project. We still like it. We hold it in our emerging companies portfolio. We're going to continue to hold it as they come into production. The management team's done a really good job delivering on it. We think it's probably worth about 70 cents. So it's trading around 50 cents. We're long that stock from memory. It's in Harry's portfolio, but I think around the 25, 30 cent mark. So it's done particularly well for us. So we're going to hold it for now. We think, as I said, it's worth around 70 cents a share. Thoughts on Whitehaven, even at these particular levels? So Barry, Whitehaven, it's hard to, so we bought Whitehaven particularly well. We've sold it a little bit too soon. A couple of comments I'd make on Whitehaven. So with the coal price where it is, they're going to continue to go. They're going to continue to be supported. I'd love it if we still own our position in Whitehaven. We made a lot of money out of it, but we've sold it subsequently too soon. At these levels, it's still cheap. So it's how best to describe Whitehaven? It's got a free cash flow yield per month of about 5%. So free cash flow yield is the cash flow that gets generated by the business minus the operating expenses on a per share basis. So it's generating 5% free cash flow yield per month. So that's like 60% per annum. That is, with the amount of shares they're buying back, this stock should be, up 40 cents a month over, if coal prices stay where they are. The big if is around coal prices. So if coal prices stay above, $400 a ton, the stock just just because they're buying back shares is going to continue to go higher. I'd be a buyer into weakness, not at new highs, but we've sold too early. Any other comments around Whitehaven, Shawn?
No, it frustrates me because you're dead right. We did sell it too early. Any dip now down towards $8. I think it looks like a buy.
I just couldn't believe the backlash that we got when we bought Whitehaven Coal. We paid $1.61 for it, and then we defended that position for a very long time to now see it at sort of $9 and doing phenomenally well. Obviously, the coal price tailwind has been huge for it. Coal prices have up 4 to 5 fold. So obviously it's been a huge winner. It was a huge winner for us in FY22. We're just not into it in FY23 at this stage. So I hope you're long it, Barry, and I hope you stayed long. In terms of other questions, we're just ticked over 1:30, so I'm not going to stick around and answer too many more. We've discussed BHP, we've discussed CBA, mineral resources. John saying another interesting part of the mineral resources business is its natural gas business isn't in the Lockyer Basin. Mineral resources has 80% of the Northwest energy and 20% seem to have found an outstanding gas discovery. They do. I like the composition of the mineral resources business. In terms of portfolio positioning, because I'm just going to get onto this very, very shortly, very quickly, I should say. We've got a bunch of portfolios that we run at Market Matters. I'll focus on our flagship growth portfolio. We've got positioning. We're holding about 14% cash in this portfolio at the moment. We've edged that high during a reporting season. We think the outlook for equities is more. We think we should have some we should have some flexibility in our portfolio as we go into September. Obviously, August reporting takes place, then we go into this vortex of news flow into September, and we're comfortable with the sort of level of flexibility we've got in the portfolio. How are you feeling about the composition of the portfolio, Shawn?
I'm going to talk about TPG Telecom overnight. That's the one stock I'm not that happy with. I've got to give that some serious thought. You and I will have a chat about that in the next 24 hours. But apart from that, I like what we've got there, James. I think the cash position is what it should be, give or take. I think people subscribers should be expecting some alerts over the course of the coming weeks as we slowly start to migrate up the risk curve. I expect going into December, we'll probably have less than 5% in cash, is my gut feel. But let's wait and see. What we've got right here, right now, especially after Jackson Hole, I think feels right.
Yep. I agree. In terms of the other portfolios, so we're holding elevated cash levels across the other portfolios. So the active income portfolio is sitting around 16% cash, which is not ideal from an income portfolio perspective. So we're conscious of that. We want to redeploy some of that cash into the market. This is a more conservative portfolio that targets the RBA cash rate plus 4%. So you can see that sort of target and how that's progressed over time. We've got a mix of hybrid securities, fixed income securities, and stocks in that portfolio. So we have, as you can see, we have Centuria. We bought that 206. It's now 184, and we've got some other, solid positions in that portfolio. We're comfortable. We're looking to redeploy some funds into that. In terms of the emerging companies portfolio, we've got around 12% cash, and in the international equities portfolio, we've got about the same. So we're going to be looking for opportunities right across our suite of portfolios as September edges on, Shawn. So I'll finish there, and thanks. I'll thank everyone for joining us today. There's some other questions there that I may not have got to, but as I said in the outset of this presentation, if you do have any questions, comments, queries, feel free to get in contact with the Market Matters team. You can jump on the website, look at what we do. You can talk to one of the team on the number provided there, or email mminvest@marketmatters.com.au. As I said, we run 2 streams of services at Market Matters. We're a digital investment platform. Some of that I've shown you today, and we've also just opened up the ability for subscribers and others to invest in our portfolios in a direct way. So please jump on the website and get some information about that if you're that way inclined. Shawn, thank you very much for joining me today and articulating some of your views in market. Shawn's, of course, our research lead here at Market Matters.
Absolute pleasure. Thank you.